I've said it on several videos about how when we deal with gaps down, there is a larger variety of gaps. By this I mean uh, the types of locations and excuse me, let me re-say that. You when you have gaps up, you have a series of uh, proximity group locations and patterns that work, and there are about there's at least a dozen locations for the proximity five, or excuse me, for the power five, in either above or under zero, or in divergence where Zion is under zero and the power 4 is above zero. With um, with gaps down, the same uh, the same locations and patterns are there oftentimes, but there is more flexibility in what uh, appears with the gaps down. Or to say it another way, there seems to be more supporting evidence, which obviously is the key. Even when we have a gap up with the minimum of 12 identical indicators in either a 1 or 2 pattern, and we have the down touches in the trend chart in one of those 6 down touches, the proximity group patterns work in the locations that they're supposed to and in the shapes that they're supposed to. Uh, and they seem, and with that, we also want supporting evidence. Or, excuse me, the more supporting evidence you get, typically, the bigger the gap. So when you find extra patterns, or when you find extra conditions that are good for uh, up movements, you then have supporting evidence for a gap up. With this particular example is with a gap down, and in the power chart on the vertical green line, we actually have a, basically a BOC pattern in all 5 of the indicators, and all 6, I guess all 6 of the indicators, and in all 6 they are above the green or the orange line. And so and most of them are in a 2-day down, uh, in a down down up pattern, a 2-day BOC pattern. And this pattern works for both uptrends and downtrends. But let me say, when you've got an uptrend, we typically we see an up up down, a TOC, a 2-day up up down pattern, and that seems to be there quite frequently with the power 4 in an up gap up. Then the exact opposite is true for a gap down. We see a BOC pattern with a down down up. And so we call them 2-day TOCs, or BOC 2-day pattern. And sometimes now we don't have it determined that we know that one is stronger than the other. And by this I mean, in a BOC pattern, down down up, is that stronger than down up up? And so there's not enough evidence to support one way or the other at this point. There is a little bit of evidence to support that if it appears in one symbol well, it'll likely appear well again in that symbol. And so from that perspective, it repeats itself quite nicely if we stick with the same symbols. This particular one is a classic in the trend red chart, in the trend chart. We have trend red that has gone down. We're in the first go up after the peak. I've done videos on this, and I've had numerous other examples that I've identified. And what we find is that the trend red goes up. In this case, it's hit the pink line, so that's the best, obviously. And we do get a nice gap down the next day. We do have, in classic form, trend blue highest. This is, sometimes it'll be a little early with green in the way, but as long as blue is going up or is pretty flat, it's great. If you put the down touch, somewhere over here, and you said if you were doing a down touch on the pink line, and when the pink is going down and the down touch occurs, it kind of bounces off rather than reflects back up and gives you a nice big candle. It just gives you a small candle. So we like to see it in the form of something that will react when we're dealing with a down touch, like where the green line is now, or even back here when we're doing a down touch, if it's going to down touch the blue line or any of those lines. Now, with the green line back to where it normally, or where it's first started out, we have trend red up touching the pink, trend green down underneath the blue, and we have divergence between red and gray. Now, that's the first set of divergence that I'll point out. The other situations that we have over here are zip Zion highest, and we know that when zip Zion is highest, and then when it goes down, we have a downtrend. In this case here, we obviously went down really strong. We have numerous indicator lines that are in a 2-day down, down, up BOC pattern. And with that in mind, it is also a lower high, which is the definition of a downtrend, or the start of a downtrend. We're high, but the peak before us was higher, and so we have a lower high, and it couldn't get back up to the height of the peak a few days ago, so we have a lower high, and it's going to go down. The other pattern that we have is a red peak in the trend chart, in the zip chart. Zip red is right at about 50. Zip red is 48.65, and zip yellow, of course, is up at 81. So that, and both of them are going up. That again is a classic, by definition, red peak, and it is a reversal pattern. Next day it's going to go down. So you have the zip Zion highest, you have the red peak highest. Those are two separate patterns, different from the location patterns within the power chart and the trend up touch. Because think of it in this way. You have we want to think like we're looking for a gap. When you're looking for in this case, when you're looking for a gap, I'll use the example, a gap up. When you're looking for a gap up, you have the identical indicators. We need 12 out of the 22 at least in either 1 or 2 patterns. It can be like 14 in 1, or it can be like a 9 and 6 in 2 different patterns. That would be 2 different pattern types. 9 of the identical in one and 6 identical in the other. And we will look at a third pattern if you're still short of 12. But it's best if you can find the patterns in either 1 or 2 groups. Then the second group of indicators that are the second pattern that we have to qualify for the gap up is to have some down touches in the trend red chart. one of the 6 down touches has to qualify. The red, green, or gray has to touch the blue, pink, or yellow lines, or the 0 line, or cross under the 0 line. And the last one is what we refer to as a sky touch. And that's when we have a couple of green candles and then it gaps way up. And so what happens is the trend red typically is going up along with the green. Sometimes the gray is up or down. But when the red usually is highest, oftentimes is highest, but that it doesn't disqualify itself if it's not highest. It still qualifies as a sky touch. So actually, everything else in the trend chart is going down, but there are so many examples of this sky touch situation. And simply what it amounts to is the bulls have taken over after a cycle bottom, and you get 1, 2, or 3 little green candles, and then boom, you get a gap up. And so the sky touch happens a lot. We see that often. And now those define the 2 patterns, the identical indicators, the down touches in the trend chart, and the third pattern is the proximity group. And that is down here. There are 2 ways that are required to make it work. You have to have location. And that would be that would be Zion and the power 4. The blue, pink, white, and yellow have to be in a particular defined location. And there's about a dozen acceptable locations. And they're all listed in the paperwork. And in this case here, we have all 6 above orange, because power orange is our dividing line. A lot of times Zion is under orange, and either the power 4, pink, blue, white, and yellow are above, and sometimes the power 3 are above, but power yellow is under with Zion. And as you know, yellow runs separately by itself, and that is obvious when we think of the yellow twins, or zip yellow and power yellow. When highest and going down, you're in a downtrend, and when lowest and going up, you're in an uptrend. And so now we're in this particular example, we have trend blue highest, which is a basic definition for this classic move in a gap down, and that is red in the first move that red goes up, and this after the peak. And so the red is going up after the peak, and it has up-touched the pink. Gray has gone down, so that divergence there. You have these 2 other patterns here. And all of that information together gives us the condition of enough supporting evidence to justify a potential gap down. Sometimes just one element is enough to do it. But you do have divergence in the swing Zion and swing pink in the fact that they are one's above 0 and the other one's under 0. Most of the time they'll both be in one place. So that in itself is another type of divergence. And sometimes we'll see like down here in the yellow, if I would bring you back to that, in the power yellow and white. Look at how big yellow went up and white just barely went up. And that's a type of divergence as well, but to qualify it, it's not real easy. Yeah, that is absolutely divergence. No, we really can't say that. But when we see those differences, we do. And then, of course, you have your trend red and trend green that are in divergence. And actually, this is the day of the last hurrah, as they say. The bulls pushed it up one more day, but it never got as high as it was on the peak of 2 to 3 days ago. And so, again, we go down. So a couple of divergent examples, a couple of other patterns to go along with it. And all in all, it was a very nice gap, and those are the types of things that we're looking for. But personally speaking, to identify what we saw, I would have identified it in the trend chart, where trend red uptouched trend pink on the first move after the peak. It goes down, 2, 3 days, maybe sometimes 4 days, and then boom, comes back up. Sometimes red comes up so high it goes back up over the blue and sticks its nose out. And you had examples of that in this situation. Swing Zion was in that format, sticking its nose out above over the all the other major lines. So